Here is something most retail traders refuse to accept. Gold is not a magic shield, and if the S&P 500 cracks in 2026, your XAUUSD position can bleed right alongside your stocks before it ever saves you. Let me show you why and how to actually play safe haven flows like a professional. When equities start to crash, the first reaction is almost never a clean rally in gold. The first reaction is a liquidity grab. Funds get margin calls, they sell what is liquid, and gold is extremely liquid. So in the opening hours of a real S&P 500 panic, XAUUSD often drops with stocks. That is the trap that wipes out traders who bought gold as insurance and then panic sell into the dip. The real safe haven move comes in the second wave. Once forced selling cools down, attention turns to the Federal Reserve. If the Fed signals cuts, pauses tightening, or hints at liquidity support, the dollar weakens on a real yield basis, and that is the fuel gold actually runs on. Watch the dollar index and the 2-year yield. When those roll over while equities are still under pressure, that is your structural long signal on gold, not the first red candle on the S&P. Now let us talk practical defensive plays for a volatile 2026. First, size gold as a hedge, not a hero. A position around 5 to 10% of risk capital is plenty for most retail accounts. Second, separate your trade from your hedge. Your XAUUSD swing position is one thing. Your short-term reaction trade around news is another. Mixing them is how people blow up. Third, pay attention to correlation regime. In calm markets, gold and the S&P can drift together. In a true crisis, the correlation flips and gold finally decouples. You want to be positioned before that flip, not chasing it. Fourth, respect the dollar. A strong dollar driven by a hawkish Fed can cap gold even in a stock crash. If the dollar index is breaking out, do not fight it with leveraged longs on XAUUSD. Wait for confirmation, like a clear lower high on the dollar and a higher low on gold. Finally, build a simple checklist: equities trend, dollar trend, real yields, and Fed tone. When at least 3 of those align bullish for gold, you have your trade. When they conflict, you sit out. That is how you survive a crash year instead of becoming a statistic. If you want my full defensive checklist for trading gold through a 2026 stock market crash, comment the word gold below and I will pin it for you.